Namaskar, hello everyone. Welcome to 6th episode of Money and Prosperity. I'm Ashok Vyas. And today I have the pleasure of welcoming someone who helps us learn more about how to shape our financial life. The gentleman is Paresh Shah, who is a managing principal of Paresh Shah Partners LLC. He's a certified financial planner and wealth strategist for the past 17 years. And he has helped individuals and businesses co-create innovative financial strategies. He's a licensed CPE presenter. He has educated CPAs as they guide their clients on investments, life, disability, and long-term care insurance. Pareshji specializes in pension and profit sharing plans, asset protection, estate planning, and business succession planning. He graduated as a chemical engineer, honors graduate from the prestigious Indian Institute of Technology at Kharagpur, India. Fast forward 2016, he was honored for Long Island Business News Leaders in Diversity Awards. Pareshji resides in the town of Hicksville in Long Island, New York with his wife Shimul and their son Shramik, who is a junior at Stony Brook University, and that tells us a little bit about family side of someone who is deeply immersed in the knowledge of financial planning. Pareshji, welcome sir. Swagat hai aapka.
Thank you Ashok ji for the great introduction.
Pareshji, I was waiting for this moment to arrive because you talked so much about insurance and some of our viewers must be confused like me because there are this life insurance, there is other insurance, and now if I may request you to help us learn about the difference between term life and whole life. You said term life, you make less investment and you get more protection. So, what is the difference between term and whole?
Let me start by giving, first of all saying that they're different products and they do different things, And end of the day, the protection becomes the primary issue. That means the money that comes to the family in case someone passes away. I was with this couple in Brooklyn and they were in their late 30s. They had, he made about 150,000 in income. She was making about 175,000 in income. So, they had about $500,000 each of life insurance from their place of work. And we sat down, there are two kids, 6 and 2, and we sat down and we said, okay, what do we need to do in order to get them adequately protected? So we proposed, last time we were talking about the concept of human life value. And when we were looking at human life value, we said it's a number that gives the same amount of income as that person. So from his late 30s all the way to 65.
Right.
Also, Ashokji, if you remember that, it is a very complex way to calculate. We were talking about that, So, what we have done is we've simplified how much a person should have in terms of human life value. So, if a person is in his 20s and early 30s, then it should be 30 times their income. If he's in his late 30s to 40s, then he should have 20 times his income. That's the life insurance that he should have. And then in the 50s, they should have about 15 times their income. In the 60s, it's about 10 times their income. So there's a kind of a thumb rule. These are not perfect rules, but these are thumb rules. So if we take these thumb rules into account, then he should have had insurance of about 3 million and she should have about 3.5 million. Now, as I told you earlier, they had both 500,000. So the gap was 2.5 million and 3 million. We proposed that they should get that. And what we proposed now, this is where the thing came. The moment I said that they needed so much insurance, they felt that it would be a very high out-of-pocket budget. So, but when we showed them term life insurance, which is about 20-year term life insurance, then that would be about $600 a month between the two of them, for 2.5 million for him and 3 million for her. And for their income combined together, which is about $375,000 a year, $600 a month for this type of protection all the way till the younger child is 22 years old was very good. We also looked at 30-year term, which is so that means term which starts today and gives you protection all the way till 30 more years. And that we saw was about a budget of $900 per month. So in between that range, they picked what they wanted, what was best for them. So what we're trying to, the concept that I'm trying to bring out here is that getting adequate protection may not mean that much. It's not a question of so much out of pocket expense. You can get term life policy which can be easy to get, which can be low in cost, low in outflow. But then there is other insurance, like when we sat down with them, we said there's also a whole life insurance, and whole life insurance, we said, okay, that is more like an insurance that will pay from now till all the way till age 121 if something happens. Now, if you want that larger coverage, naturally you have to put more money out of pocket. And what we did was, we sat down with the couple and we saw their debt. I was talking about liability issues some episodes ago. So we readjusted their debt and we found that then increased their savings by about $12,000 a year. Once we did that, we were able to take that $12,000, that is $1,000 a month, and put it toward this whole life insurance. A portion of the money, $6,000 for him and $6,000 for her. So as you can see, while we were trying to see to it that immediately the family got good protection, that means they got the type of protection that is needed, so that if tomorrow morning, if one or the husband or the wife dies, economically a pool of money comes in and the same income comes to the family. We took care of that using the lowest cost product out there, which is term life. But then if we want to do more and take it to end of life or make it a source of tax-free income in retirement, then we use whole life insurance. So
Parijit, this so much information today, term life, whole life, and you also helped us understand more about term life. Less premium and more protection is the simple way of understanding it. But what you said, whole life kind of gives us some idea as to you can also have some recurring income from the whole life. So how that happens, and that means you put in a lot of money, then only you can draw something like that?
Yeah, you're pretty correct. I like to explain the difference between term life and whole life, like from the perspective of the way of our living, or our the home we live in. So term life is like living in a rental house. Let's say a person does not own the home or does not have money to buy a home. That doesn't mean he lives without a home, right? He will rent out the home. So how does he rent out the home? Let's take a theoretical example that he signs a 20-year lease with his landlord. So every month he pays the rent, and so long as he pays the rent for 20 months, he has a cover on his head, he has a roof for protection. So in the same way it is with term life. Term life is you pay in money, and so long as you pay in money, there is a roof on your family's head, that is, in case you pass away, a pool of money will be delivered to your family. But after 20 years, let's say you're in that rental house and your lease is expired. If you have to leave that house, do you carry anything with you?
No.
Only your personal belongings. The house, the appreciation on the property, everything belongs to the landlord. In the same way, in a term life policy, you paid money to the insurance company, but if you did not pass away in those 20 years, then that money will all be there with the insurance company only. You don't get anything. So then let us take what is a whole life. Whole life, I would equate it to buying a home on a mortgage. So you buy a home on a mortgage, and let's say you buy it for a 20-year mortgage. Each year you pay the money inside. Now, as you pay money into the mortgage, your loan becomes lesser and lesser. But not only does your loan become lesser, there is a component which is your equity inside the house. They call it equity. That keeps on increasing. So after 20 years, you took a house for, say, $250,000 and you took an entire loan. I'm just taking theoretical example again. You took the entire money as a loan. But 20 years later, you would have put in that $250,000. So it's what is called a paid up house. Now, at the end of the 20 years, not only do you have the whole house, because you can live in it for the rest of your life without paying any more to the bank for mortgage. Not at some point, you can use the equity inside the house, that cash value, by getting the line of credit, and you can use that for income in retirement. There is something new thing called reverse mortgage, which helps you get income in retirement. That is tax-free income. Let's take a similar example with a whole life policy. Now, as you can correctly point out, the mortgage payment normally is much higher than what would be a rental payment, right? That is normally the case. Same way, you put in more money, but each year as you put in more money, there is a build-up of cash. 20 years you pay in the money. After 20 years, you stop paying in money, but yet the protection continues. That means for the rest of your life, up to age 121, the policy will continue.
That is a good point.
Yes. And then also, the money that is being built, that is you put in capital for 20 years, if you at age 65, you can get a small stream of income also from that capital, and yet you can have the protection of life insurance till end of life. So in this way, it's like a house on ownership, So we're getting, we're building our cash. So we're building equity. We can use that money as income. But the main thing is all along the family as protection, which never stops. That's why it's whole life, because it goes all the way till age 121.
So, Paresh, you have explained it very well, but then there are other terms in the market that one hears. In addition to term and whole life, there is universal life or variable life. I mean, there is one variable life, one is universal life, and there is one more indexed life, something like that. What are these things?
Ashokji, I must say that the world of insurances after 1980 was when the first universal life was introduced. Then 1990 was when variable life was introduced. It's become a bit complex, okay? Whole life was, as I told you, a steady, simple growth, and you pay the money and it goes up. But now some people wanted more. So what they threw in was that they said that the money that you're putting into the policy, let us, instead of keeping it in some secure investment, let us invest it in the stock market. That will give us much better returns. So those type of policies were called variable life policies. Then there were universal life policies where you could have some flexibility in the amount of money that you pay. And then index is a further type of policy. What I'm trying to say is that this is why it is like, this is why it has become like, different medicine. Now, if I tell you, Prozac is a medicine, Zocor is a medicine, Crestor is a medicine.
I'm kind of already trying to understand these terms from financial world. Now you bringing these names of the tablets. So as we just have a little bit of time left, let us get to the bottom line. Which is a good product, which is not a good product?
All the products are good. I think it is the application. I was just coming to that point when I was saying medicine. There are all good medications, but what is going to help your situation, take care of your health, is to be decided by the professional who works with you, in case of physician. He checks you, he examines you. That is why it is very important with all these myriad products available and them getting more and more complex as the days go by. Sit down with your life insurance professional, go through your needs, obtain term life, and then when you want better than term life, policies that grow, policies that provide income in retirement, make someone understand what you're looking for, and that life insurance professional will then be able to go back and determine which product is best for you and what is your capacity to put in money. So I think the financial planning element in life insurance has become very, very important.
Indeed. Pareshji, when you explain these things, one feels like a student. And I think this learning continues. And if there's someone who is passionate about the subject, you enjoy learning. And if you apply what you learn and if it helps you, then you want to apply more. And if you feel like doing that, the number where you can reach out to Paresh Shah ji is G is the way of respect. So his name is Paresh Shah. Paresh Shah. His number is 516-268-3446. Paresh, thank you very much for being with us, sir. Lots of good
Thank you, Ashok ji. Thank you, viewers, and look forward to catching up again in a couple of weeks.
Not a couple of weeks, next fortnight. So every fortnight we have Money and Prosperity, Sundays at 10:45 a.m. on ITV Gold. Thanking Paresh Shah, CPA?
CFP.
CFP.
That's right.
CFP. Paresh Shah, CFP, and thanking all of you for being with us. This is Ashok Vyas.